21st Century Fox's board is set to meet later this week. Topping the agenda, Comcast's $65 billion bid to buy most of Fox's film and television assets. The gathering takes place a week after Comcast threw a wrench into Disney's plans to purchase the bulk of Fox. Joining us now with more on the bidding war is Managing Director at LJH Investment Advisors, Larry Haverty. Larry, the ball is squarely in Disney's court at this point. What do you expect the next move will be?
Well, I think this is summarized by an executive named Jack Tramiel, who was with a company called Commodore in the 80s, who was an original disruptor. And the quotation Dagan is business is war. And what we have here is war of the titans between two media giants that have phenomenal intellectual property on both sides and phenomenal balance sheets and very, very strong management. You have a desirable asset, and let the games begin. Disney's clearly going to go higher. I think this thing is going to rival the Paramount QVC Viacom fight in the early 90s. My own personal guess, by the time it's finished, the Fox stock will be up probably another $5 or $6. I think maybe that'll take 5-6 months to play out. I think the stock that loses is going to be very attractive. I think the one that wins is probably going to be less attractive. But at the end of the day, the transaction price for Fox will be more than I think what the market would like. And the market's reasonably amorphous. But I don't think the market's going to like Fox assets going at 14 times cash flow, which is, I think, where things are going to end up.
Larry, good morning. Mitch Rochelle here. The thing that's pretty clear is content providers and those who own the distribution or the pipe are looking like they need to get together. So regardless of how this deal plays out, is this a trend where we're going to see massive consolidation in that space?
I really don't think so. And you know, you have to go back 17 years to the AOL Time Warner thing, and I thought the comment of Randall Stevenson over the weekend was really pretty interesting. That he was more or less going to let he's got a new guy running the Time Warner assets, but they're really going to, you know, more or less run themselves. Now, when you spend upwards of $50 billion buying something, you aren't going to leave it alone. You're going to manage it. And in order to manage it, you have to have the intellectual capability to run those businesses. The tech companies really don't have that capability. In this situation, both companies have the management capabilities. It's a merger within the same industry. They know precisely what they're buying. So I'm not looking at a wave of mergers. The other thing is the buyers in the tech industry, the Amazons of the world, if you will, they have multiples 18 to 40 times. The entertainment businesses are 9 to 11 times right now. Maybe they're, if I'm right, are going to go out at 14 times because of the uniqueness of a particular asset. But you run the risk of the multiple degrading into the lower level, and your shareholders lose a lot of money. And I think the tech guys are smart enough not to do this.
Larry, great to see you. Thank you so much for the breakdown. Larry Haverty, take care.
Okay.